let me now bring on board Krishna Kumar Karwa, Managing Director and CFO with the Emkay Global Financial Services. KK, morning. Thank you for joining us. KK, the bulls are of the view that the bear market has ended and a new bull market has started. Naysayers are of the view that this is a liquidity-driven market and the fundamental turf is still very weak. What is your assessment?
I think we should appreciate the fact that there has been a global liquidity-led rally across all global markets, and we are also participating in that. And after the deep cuts of last year, we have probably been the best appreciator in the last 45 days odd. So our markets, I would think that with the 20,000 crores odd of FII buying, so we have had our fair share of buying coming in, and we have moved up sharply. As far as fundamentals are concerned, there are challenges going forward, and currently the market, the way it is poised, is at kind of fair valuations. So from here on, for the markets to move up further, there could be more global liquidity-driven rally and markets could go up further. Otherwise, on valuations, on domestic fundamentals perspective, probably this is the time to be very, very careful.
When you say careful, what exactly are you advising your clients? Are you advising your clients that they should book out, they should lock out, or in a strong momentum stroke liquidity-driven market, don't sell anything?
No, I think it's the best to be very, very stock-specific and treat each stock on fundamentals. And if some of the stocks you find are getting overvalued in this rally, then you might as well shift out of that rather than trying to catch the top. So it's better to be very, very stock focused and play the market than trying to just take a call on the liquidity.
KK, but we've seen that the drivers of this rally really have been the entire high beta beaten down names. Considering you are advising a stock specific approach, what do you think would drive the markets further from here onwards?
We have 2-3 events upcoming, which is your post your UP state elections and other state elections. You have your budget and the results itself in the state elections. So these are the two domestic events which could help the markets to take a further upward trajectory. And if there are disappointments in these two events, then there could be challenges. So finally, we do respect liquidity, but finally, ultimately, your fundamentals prevail, and current domestic fundamentals are not exactly the best. So we have had an uptick because of the global liquidity, but now domestic fundamentals will start coming into play. And if you look at the flows also, domestic institutional investors have been regularly selling in the last 30-40 days because they can see the fundamentals and accordingly they are positioning their portfolios.
PK, if I look at historical trends and if I look at last 5-year data, Indian markets, they have always corrected in the month of Jan and they have always appreciated in the month of Feb, and we call that as a classic pre-budget rally. This time around, do you expect a classic pre-budget rally?
I don't think so. This is a classic pre-budget rally. I think it's hardly been a global liquidity-driven rally. We were at 4,600 odd at the end of December. In the last 10 days of December, when there was ferocious FII selling, none of us could take a call at that point of time that we would be at 5,400 in the mid-February. So I don't think so. This has been a case of any pre-budget kind of rally. Expectations were very low in the beginning of the year. I mean, now sentiment has changed because of the strong FII flows, and so now we are talking of, yes, there were expectations about budgets, etc., but this kind of an uptick in the market was not expected.
So what are your clear bets for 2012, and where after a 15% run-up also, you're still confident that in next 12 months, those stocks, those names or those groups could appreciate by another 15%?
If you believe that the economy will improve and there will be measures in the budget to help improve the economy, then your banking financial services sector still continues to offer very good opportunities for further appreciation. No doubt they have moved up sharply in the last 30-40 days. But being a driver of the economy, that's one segment which will continue to do well. And if you look at your IT pack has kind of underperformed in the last 30-40 days. So maybe that's one segment which has got good earnings visibility, and that could be one more sector which should continue to do well. As far as real estate, infrastructure and cap goods sector is concerned, valuation wise maybe the cap goods infrastructure sector could give you an opportunity, but in terms of earnings visibility, I think there are some challenges still over there.
KK, what about the global picture? Because now the markets have got the Greece deal. It seems to be on deadline, but the stocks really aren't reacting as much. Do you think the good news from Greece and the tragedy being averted was something that equities had already priced in?
The global picture keeps on changing very rapidly, but the fact remains that by the month end again you have one more round of liquidity being expected to be injected into the European banking system. And I think post the first round of liquidity, post the first round in the last week of December. So now again this liquidity-driven rally is on, but I have a feeling that in anticipation of the second round of liquidity injection, our markets and global markets have already moved up sharply. So this is a time to be cautious.
KK, so if currently global markets are moving up because of liquidity, it's a rising tide which is taking everything up. So my follow-up question is, how does one map or monitor liquidity?
Sorry, I didn't understand.
How does one figure out? How does one map liquidity? That liquidity will dry up, liquidity will come here, liquidity will not come here?
This is a challenging question, and that is why it's better to be very, very fundamentally focused and take your equity bets based on the fundamentals of the stocks rather than trying to take a call on the liquidity, because liquidity, but historically it has been seen that in India at least that you have these periods of 40-45 days where you have 15,000-20,000 odd crores coming in, and that's the kind of hot money that we see, and then suddenly things take a turn for the worse, or rather there are some outflows. This has happened twice, thrice in the last few years, and if you look at the numbers that we have seen almost 18,000-20,000 crores of inflows now in the last 40-45 days. So if you go by that trend, then probably it's the time to be cautious.
You can answer this one, KK. Are we still in a bear market or the new bull market has started? Think and answer. It's an important question. Bear versus bull.
I think, there was this bear market, there was this correction of almost 20% plus last year, and so we have corrected that, and structurally we are in a positive market in terms of our demographic profile and the opportunity that India as a market provides to investors. So broadly we are in a long-term bull phase, and so we are in an uptick in that phase.